Right now, as you watch this video, the Fear and Greed Index sits at just 15 out of 100. That means the market is in a state of extreme fear. Billions of dollars are being wiped off portfolios. People are panic selling, logging out, looking away. And somewhere else, the smart money is getting ready to buy. Warren Buffett said it best. The entire secret to beating the market is learning to feel the opposite of what everyone else feels, but here's the problem. That's incredibly hard to do. Because fear and greed are hardwired into your brain. They evolved to keep you alive, not to make you rich. In this video, we're going to cover what the Fear and Greed Index actually measures, the brain science behind why we make terrible decisions under pressure, real historical examples where fear and greed cost people millions, and most importantly, a practical system you can use today to trade against the crowd. Stay until the end, because I'm going to show you the exact 3-step system that contrarian investors use to turn market panic into profit. Let's get into it. What is the Fear and Greed Index? So what exactly is the Fear and Greed Index? Think of it as the market's emotional thermometer. A single number from 0 to 100 that tells you how investors are feeling right now. It was created by CNN Business and tracks 7 different market signals. These aren't opinions or surveys, they're hard market data. Number 1. Market volatility, measured by the VIX index. When the VIX is above 30, investors are terrified. When it's low, people are relaxed. Number 2. Market momentum. It compares the S&P 500 to its 125-day average. Above it? Greedy market. Below it? Fearful market. Number 3. Stock price strength, comparing how many stocks hit 52-week highs versus lows. Number 4. The put-call ratio. When investors buy more put options, it means they're betting on drops. Pure fear. Number 5. Safe haven demand. Are investors fleeing to gold and government bonds? Number 6. Junk bond demand. Are people taking risky bets or playing it safe? Number 7. Stock price breadth. How many stocks are actually rising versus falling? Right now, all of these indicators are flashing fear. We've been in the extreme fear zone for 38 consecutive days. That's the longest since the 2022 bear market. Here's how to read it. 0 to 24 is extreme fear, potential buying opportunity. 25 to 44 is fear, investors are cautious. 45 to 55 is neutral, waiting for a catalyst. 56 to 75 is greed, prices may be overvalued. 76 to 100 is extreme greed, correction is likely coming. Here's the key insight that most investors miss. The best time to buy is when this number is low. The best time to be cautious is when this number is high. That's the contrarian approach, and it's backed by decades of data. But why is it so hard to be a contrarian? The answer is in your biology. Let me explain. The brain science. Inside your brain sits a tiny almond-shaped structure called the amygdala. Its job is simple: detect threats and trigger the fight or flight response. The problem? Your amygdala can't tell the difference between a tiger and a red stock chart. When your portfolio drops 20%, your brain triggers the exact same panic response. As if a wild animal was chasing you. Adrenaline spikes. Rational thinking goes offline. One instinct takes over. Get out. Now. Nobel Prize-winning psychologists Daniel Kahneman and Amos Tversky proved this. Losing $100 hurts about twice as much as gaining $100 feels good. This is called loss aversion, and it makes us terrible long-term investors. And then there's herd mentality. When you see everyone around you selling, your brain assumes they know something you don't. You feel social pressure to join the herd. Even if rationally, you know it's the wrong move. Now let's talk about greed. When markets are rising, your brain floods with dopamine. Dopamine is the reward chemical. The same chemical triggered by gambling, social media likes, and watching your crypto go up 40% in a week. This dopamine rush creates FOMO, fear of missing out. When prices are at all-time highs and everyone is posting their gains on social media. That's when most retail investors jump in. Right at the top. Right before the crash. And once we're in, confirmation bias kicks in. We seek out only the news that confirms our belief. If we bought Bitcoin at the top, we keep reading bullish articles, ignoring all the warning signs. This is the emotional market cycle. Optimism builds into excitement. Excitement into euphoria. Then comes anxiety, denial, fear, panic, and finally capitulation. That's the bottom. That's where the opportunity lives. Here's what's wild. Institutional investors know this cycle exists. They study the Fear and Greed Index. They track sentiment data. They buy when retail investors are panicking. And they sell when retail investors are celebrating. So what's the takeaway from all this brain science? Your emotions are real, but they are not reliable market signals. Awareness of these biases is the very first step to overcoming them. Let me show you with real historical examples. Because seeing these moments in history is the best way to recognize them in real time. Historical lessons. Case study number 1, the dot-com bubble, year 2000. The internet was new. Every company with a .com in the name was worth billions. The Fear and Greed Index was sitting near extreme greed, above 90. Taxi drivers were giving stock tips. Teachers were quitting jobs to day trade. Everyone knew prices were absurd, but greed silenced the rational voice. Then in March 2000, the bubble burst. The Nasdaq fell 78% over 2 years. Trillions of dollars in wealth, gone. Not because the technology was bad. Because the greed had become completely untethered from reality. Case study 2, the 2008 financial crisis. By October 2008, the Fear and Greed Index had collapsed to a reading of just 3 out of 100. 3. That is historically almost impossible fear. People were selling everything. Stocks, bonds, gold. Retirement accounts were being cashed out at massive losses. The fear was so overwhelming, rational thinking had completely shut down. But here's what happened next. Investors who bought at the peak of fear in March 2009 watched the S&P 500 triple over the next 5 years. The biggest opportunity in a generation, handed to those brave enough to be greedy when others were fearful. Case study 3, COVID-19 crash, March 2020. The S&P 500 dropped 34% in just 33 days. The fastest crash in stock market history. The Fear and Greed Index? Back down to 3. And then, a V-shaped recovery like nothing we'd ever seen. By August, just 5 months later, markets had fully recovered and hit new all-time highs. Panic sellers locked in their losses. Patient buyers were richly rewarded. Case study 4, the 2022 crypto winter. Bitcoin collapsed from $69,000 all the way down to $15,500. The Crypto Fear and Greed Index spent 74 consecutive days in extreme fear territory. Do you see the pattern? Extreme greed at the top. Extreme fear at the bottom. Recovery after the fear. This cycle has repeated in every single market crash in modern history. The index tells you where you are in the cycle, if you're willing to listen. And right now, in March 2026, we're back in that zone. Rising oil prices, global inflation pressures, geopolitical uncertainty. The index is at 15. History says, this is where opportunities are created. But, and this is important, extreme fear does not mean automatic recovery. In 2018, the market stayed in the extreme fear zone for 92 consecutive days. The index is a tool, not a magic signal. You need to combine it with other analysis. How to use the index? Alright, let's get practical. Here is the 3-step system I mentioned at the start. Step 1, monitor. Step 2, confirm. Step 3, act. Simple to say, harder to execute. But let me walk you through it. Step 1, make monitoring the Fear and Greed Index a daily habit. It takes 30 seconds. Go to CNN's Fear and Greed page every morning. You're not making decisions yet. You're just tracking the trend. Is the index falling? Rising? How many days in the same zone? Set mental alerts for 2 zones. When the index falls below 20, that's your red alert zone. Start paying attention. When the index goes above 80, that's your yellow caution zone. Start being careful. Step 2. Confirm the sentiment with other signals. The Fear and Greed index tells you the emotion, but you also need the fundamentals. Are stock valuations reasonable? What do moving averages suggest? What's the macro environment? Here's a strategy that removes emotion almost completely: dollar cost averaging. Instead of timing the market perfectly, you invest a fixed amount every month. You automatically buy more shares when prices are low and fear is high, and fewer shares when prices are high and greed is elevated. For more active investors, you can scale your position size to the index. When fear is extreme, be fully invested or close to it. When greed is extreme, reduce exposure, hold more cash. This isn't about perfect timing. It's about being in the right position at the right time. Step 3. Act according to pre-written rules, not in the moment emotions. This is the hardest part. You need to decide your strategy before the crisis hits. Because in the middle of a panic, your amygdala will override everything. But if you have rules written down, you can follow them even under pressure. Here's an example of what your rules might look like. Rule 1. Never sell in a panic. Rule 2. Increase dollar cost averaging when the index drops below 20. Rule 3. Review your allocation when the index exceeds 80. Rule 4. Don't obsessively check your portfolio. It makes emotional reactions worse. Warren Buffett doesn't even check the index every day. His approach is even simpler: buy great companies at fair prices, hold for decades, and tune out the noise. He bought more Coca-Cola during the 1987 crash. More Wells Fargo during 2008. The Fear Index was his invitation to act. Before we move on, let me highlight the common mistakes investors make with the index. Mistake 1. Using it in complete isolation. It's a guide, not a guarantee. Mistake 2. Going all in the moment it hits extreme fear. Timing a bottom is nearly impossible. Mistake 3. Treating the index as a short-term trading signal when you're a long-term investor. Here's the contrarian paradox that every successful investor eventually accepts. The right move almost always feels wrong. Buying when you're terrified feels wrong. Selling when everything is going up and everyone is excited feels wrong. But that discomfort? That discomfort is the edge. One of the best ways to remove emotion from investing entirely? Automate it. Set up automatic contributions on a fixed schedule. You can even set rules with your broker. Invest more in fear periods. When it's automated, your amygdala doesn't get a vote. Historical data shows that the average time from a fear trough to neutral territory is about 67 days. That's 2 months of sitting with discomfort, watching red numbers. Most investors can't do it. The ones who can, those are the ones who build real wealth. Your action plan. Okay. Let's turn everything we've learned into a concrete action plan. 5 steps. Simple, practical, and designed to work with your psychology, not against it. Action 1. Continue educating yourself on behavioral finance. 2 books I highly recommend. Thinking Fast and Slow, by Daniel Kahneman, and The Psychology of Money, by Morgan Housel. Understanding your biases intellectually makes them slightly easier to resist emotionally. Action 2. Bookmark the CNN Fear and Greed Index page right now. Set a daily 5-minute check-in every morning, just to track the trend. Not to make trades. Just to stay aware of the market's emotional temperature. Action 3. Write your personal investing rules, today, not during a crisis. Include your response to different index levels. Include what you will and won't do during a crash. And then, commit to following those rules even when it feels wrong. Action 4. Automate your investment contributions. This removes the single biggest risk in personal investing, you. When your contributions are automated, there's no decision to second guess. No panic moment to resist, no temptation to time the market. Action 5. Invest in your emotional resilience. Seriously, sleep, exercise, time away from financial news. The clearer your mind, the better your decisions. Studies show that stressed investors make measurably worse financial decisions. Here's the most important visual in this entire video. This is the S&P 500 from 1928 to today. Every crash you can name, 1929, 1987, 2000, 2008, 2020, visible as small dips on this chart. But the long-term trend? Undeniably upward. The market doesn't just survive fear and greed. It grows through them. Let that sink in. $1,000 invested in the S&P 500 in 1928 is worth over $7 million today. Missing just the 10 best trading days per year cuts your returns in half. The average bear market drops 33%. The average recovery? 163%. Right now, the index sits at 15. Extreme fear. History says this is where wealth is created. Not for the reckless. Not for those buying randomly without a plan. For the prepared. For those who understand what fear is, where it comes from, and how to act against it. OUTRO. Let's bring it all together. Today we covered what the Fear and Greed Index actually measures. Why your brain is hardwired to make terrible investing decisions under emotional pressure. For historical crashes where fear and greed cost investors everything, and rewarded the contrarians. And a practical 3-step system you can apply starting today. If you take one thing away from this video, make it this. The market rewards those who control their emotions. Not those who predict the future. You don't need to know what's coming next. You need to know how you will respond. Here's my challenge to you. The next time you feel the urge to panic sell, or chase a hot investment, pause for just 24 hours. Check the Fear and Greed Index. Revisit your written rules. Then make your decision. That 24-hour pause could be worth thousands of dollars over your investing lifetime. I want to hear from you. What number is the Fear and Greed Index right now as you watch this? And have you ever panic sold? What happened? If this helped you understand your investing psychology better, stay consistent, keep learning, and keep improving your decision-making. The market will always be volatile. Fear and greed will always move prices. But now you know what's happening beneath the surface, in the data and in your own mind. Use that knowledge. Protect your future self from your emotional present self. I'll see you in the next video.